Joining me now are Slated CEO Stephan Paternot and Dick Bove is Chief Financial Strategist at Odeon Capital Group. It's great to have you both here. And Stephan, I'll start with you. I don't know if you would defend Silicon Valley. I mean, you yourself saw when you guys went public in 98 or 99, this huge one-day pop, which Bill Gurley today is saying, and I will quote, he says, investment banks have been fleecing companies, Stephan, by pricing shares low so they pop on their first trading day. It benefits institutional clients who buy at the offer price and flip their shares when they soar. Is this Wall Street's fault?
I would say that, well, it takes two to tango. And when you've been in this business, certainly in the tech sector and living through the IPO era for 25, 30 years, you start to see these cycles and repeating patterns that are rhyming. Yes, I've stated ever since the Globe IPO, the Globe.com IPO, that I think the public markets, the gamification of how to go public and how to play the game every single quarter is a very broken system. It's very myopic. It's very short-term driven. And of course, whoever, especially Wall Street, but investors in general, all want to get rich quick. So there's a lot to unpack here in terms of reforming the process of going public, what it's like being a public company, the gamification of it, but also everyone is looking to make a quick buck, and we're now seeing a repeating cycle of taking the most exciting and overvalued and overhyped companies and trying to see who will be the last investor who will come in at the table and take on all the losses. Yeah,
so you're saying it takes two to tango, the companies and Wall Street. Dick, we know there's this meeting of venture capitalists. They've invited more than 100 startups to a San Francisco meeting, starts about 1 p.m. local time, to convince them to go public through direct stock exchange listings instead of IPOs as a way of kind of getting back at Wall Street. What's your reaction to that?
Well, I think that the reason that this is happening is because, there was a shortage of shares in the marketplace. In other words, with all of these companies buying back stock and with no issues coming to market a couple of years ago, you were developing a shortage. So the prices of stocks continue to rise at a pretty rapid rate. And we've had this 10-year bull market. So the net effect is it would be normal for Wall Street to be going to Silicon Valley and any other place in which they can find more shares to sell because the demand for shares was so high. Now, as was just indicated, it's a major, if you will, dance to determine who you're going to pick as your underwriter and who you're going to pick in terms of the company that you want to underwrite.
Right.
And therefore, it's not, you can't easily blame one side or the other. But the bottom line is, once you start meeting the total demand for shares, and think of shares as just a product being sold in the market, once you start meeting the demand for shares, it doesn't matter whether the underwriters do it or whether the venture capitalists want to go directly. So, the prices just won't go anywhere.
Dick, here's the data, which this is from Jay Ritter at the University of Florida, says for the past decade, Goldman led in underpricing venture capital-backed IPOs. Its issues on average notching a first-day gain of 34%, Morgan Stanley 29%. Is that an indictment of what they're doing or what they're doing wrong? And if these companies start to push back, do Goldman and Morgan have a lot to lose here potentially?
Well, I don't think they have a lot to lose because ultimately, if you want to go public, you're going to have to, and you're a large company, you're going to have to use the services of Goldman, Morgan, J.P. Morgan, Bank of America, et cetera. You can't distribute your stock evenly. And this gets back to what the issuer wants. In other words, does the issuer want, the stock spread to retail? Does it want an institution? What size blocks are they willing to sell? Do they want it to be sold overseas? Do they want to give some incentive because they think a year and a half from now they're going to come with a secondary?
Okay.
So there are so many questions that have to be answered. It's the company that has the best marketing plan that will generally get the deal.
And here's what Roger McNamee had to say about all this this morning. He was on Squawk Alley, guys. Take a quick listen.
I don't think this fixes the core problem in venture today, which was we've had a mania around growth at any cost, really taking Reid Hoffman's notion of blitz scaling and saying if you get big enough, it doesn't matter that your business model is terrible, you'll still create a lot of wealth. And I think we're now seeing that there's a dark side to that because the public market's looking at this and saying it's ridiculous. This is not about how you list. It doesn't matter whether you do a direct listing or an IPO. What matters is that you have a business model that's worth something.
And again, Stephan, do you think he's right about that and that the timing of these IPOs at what people have said is peak losses is the real problem here?
Yeah, I tend to agree with that particular statement. And as I was mentioning, we're going through these giant cycles, hype cycles, and then where the public market, which is usually the last player to come in on a series of financings, is now wising up. And I would say that, we went through this in the late 90s, right, where anything.com was exciting and became overvalued. I lived through that myself with the Globe.com. But then, when the internet renaissance kicked in, Google going public, Facebook eventually going public, those were companies generating billions in profits. Now we're hitting that peak hype cycle again, and it really started off, a year or two ago with Snap's IPO, followed by Lyft, Uber, and now WeWork failing, which is to say that these companies are simply losing too much money and getting too big for their own britches, and the public market is saying, wait a second, how many years do we need to wait and subsidize these losses before we prove they can make profits?
And again, if Airbnb goes the direct listing route, which is, that reported this afternoon as well, it will be because they're EBITDA positive, which is a whole difference between them and some of the other names that have struggled. Guys, thank you both. Appreciate it today very much. Stephan Paternot and Dick Bove.